So hey guys, just before you get into the video, I wanted to clear some things up with stat trading. Right now, we are focusing 100% on strat and stocks. When it comes to futures and stuff, it's still something that I am relatively new at, especially with ICT. That's something I picked up just within the past like 6 months. And it's not something I feel 100% comfortable marketing and charging and relaying to other people when I don't have my system 100% to a T the way I do when it comes to trading the strat and stocks, which doesn't mean that strat doesn't work. We've had some very, very great trades in the past 2 weeks, but it does mean that it's not something I'm comfortable, or not the strat, but it does mean that this ICT stuff is not something I'm comfortable trying to like mentor people on. So as of right now, this video is going to serve as helping me practice and walk through my strategy. And again, teaching makes things solidified for me, and it also helps you understand what I'm thinking about when I'm trading. So hopefully this video helps you guys, and I'll let you guys get to it now. Hey guys, so this is going to be the video talking about ICT and strat and how I've been combining them and how I've been trading ICT to hopefully shed the light on that in a more in-depth way to help you guys out. And I guess we'll just get right into it. So first things first is if you are coming from ICT and you have no idea what the strat is, please go into the top right corner of this video and check out my Strat A to Z series. That is going to be really helpful for you to understand what I'm talking about when it comes to making daily bias incredibly simple, and some of the other concepts in here that might intrigue you or potentially could help your trading. But anyways, we're going to dive right into it. So first off, I recorded this video actually twice, and the second time I recorded it and got it all the way through perfectly, I messed up and hit stream instead. So all of my notes are already here. So we are going to be clearing all of this out, and we'll first off start on the daily chart. So first off, today, what do we know about price action in trading when it comes to the strat? If we go to the monthly chart, we are bright red on the month, taking month down, etc., etc. We know it's downside bias. We go to the weekly chart, 2 down on the week. We know it's downside bias. We go on the daily chart, potential rev strat day to take out previous daily low for the 3, 1, 2, 2. We know about that. It's exactly what we did. We took out last month's lows. So very bearish day, expected it fully, and just so you know that we expected it, wifey's in red heels, steak dinner tonight. So yesterday, potential bloodbath tomorrow, and guess what? Night is young, still could turn around. That's why I say 12-hour futures will let me know tomorrow. This is the first major thing about strat and ICT and how I use the strat for my daily bias. So what I found is that the 12-hour charts are going to be the best when it comes to using the strat for your targets, magnitudes, bias, etc. And the reason being is because if you look at this daily chart and you understand what the strat is, you know the daily trigger's right here and the daily magnitude's right here. So looking at that, that's only 46 points, just about. That's kind of shit when the whole daily range is 168, 165. You're getting about a fourth of the daily range, right? So, not a fourth, just about a third, maybe a little less, right? Not very good. Go to a 12-hour, changes the whole thing around. You get inside 12-hour Momo shooter candle pattern, 312 to the downside. This downside magnitude target is your daily trigger, and then your next target down here is your daily magnitude. So it makes it really simple. We already know that. And now, from understanding that, we know to be shorting inside this candle because we're expecting downside prices. We have everything pointing down, and we want to short, anticipating that this is going to trigger to the downside. So now, let's jump back into replay mode. Go to a 15-minute. This is your bellwether chart when it comes to ICT. We'll actually go to an hourly first. So when ICT talks about bias and stuff, we're looking at this high, and we're not expecting this high to get taken out. Why is that? We have a fair value gap on the side of this high right here, and we're expecting lower prices, which means that this is our invalidation point, and we wouldn't expect price to go up there. But the way I'm going to be doing that is I want to see this 12-hour trigger to the downside and start breaking structure lower, because we have higher high, higher low. So higher high, higher low, higher high, higher low, starting to make that lower high, play it through, makes the lower low, and I forgot we were on an 12-hour chart. Makes the lower low. Now we know to be shorting in here, and we know our invalidation is going to be right here, right? So go to a 15-minute, nothing really. This is where it gets really interesting. So what I do is I use a 1-minute chart, and it's just because it lets you see all the price action. It also lets you get very, very, very tight entries. And before we dive into this 1-minute chart right here, what is the importance of getting those really tight entries? Well, let me just do some maths down here for you. So if you're trading a $100,000 account, that means you are risking about 1% on your account, which is what I do. I'll risk between 1 and 3, but for this video, we're just going to make it 1% to make it really simple with a $100,000 account. So if you're risking 1% of $100,000, we know that's $1,000. So the strat does not talk about risk reward, which I believe is kind of a downfall to it, but it's also, it makes sense because we look to add to our winners as they go in our favor. But some people just don't like adding to their winners. Some people would rather take the big position and try and get near the highs, or take a big position and try and let it run as long as possible, right? Which is what I kind of figured out that I prefer to do. So if you're risking $1,000 on your account, let's say you're risking 10 points and you're looking to make 20. So this trade right here, 1 to 2 risk reward, you're risking 1,000 here to make 2,000 here. Now, imagine that you are able to change that to risking, we'll just say 3 points up here, and still targeting that same amount. That's now 1 to 8.5, or yeah, 1 to 8.5 risk reward. So on your risk, you're doing 8.5 times your risk. So now understanding that, if we're trading ES contracts on that first trade, a 1 to 10 risk reward on ES, 10 points is going to be 10 times 500, or 50, my bad. That turns out to be 500. So you can only take 2 contracts on ES, because 2 contracts, they stop you out here. That's going to be $1,000 loss. Now, if you change that, and we're looking at it like this, now that's 3 points. So that's $150. So you take that $1,000 risk, divide it by 150. Now you can take 6 contracts short. So by minimizing your risk a little bit more, you are increasing the amount of money you're going to make on this trade. And it's the exact same trade. So this is why risk reward is important, and why I focus for it on futures. On stocks, I have a completely different way of trading, and some people find it kind of crazy that I can trade 2 completely different ways, but stocks, this video is not going to be about stocks. This is solely futures, just so you understand. But that same trade can be, instead of being a 1% gain on your account for a 1 to 2, or a 2% gain on your account, if it's a 1 to 2 trade, 1 to 2 risk reward, that would instead be an 8.5% gain on your account, and it's the same trade. So it's kind of crazy how that can work, right? So understanding that, we want to look for really low risk entries. So looking at this in ICT terms, so we took out this swing low. If we're expecting bearish prices, we want to be shorting above previous highs. So immediately our eyes are drawn to this high, right? And this is New York Open here. But looking at this price action here, we have accumulation, sweep of the low, and then you'll notice we get more accumulation, right? So we get more and more accumulation. We did not get a very big sweep of this high. Important, but important to know, I want to see price go actually above the high and then reject. So I would not count this as a sweep. I would just count this as relative equal highs. And the reason being is it only went above by about half a point. So looking at this, I treat this as double top liquidity, and I want to see prices come above this high. And you can see we have some more liquidity back here. and we sweep those. And we also fill this little imbalance that we left above this high here. Not too important, but we are sweeping this liquidity now. So we know that there's obviously buy orders down here from these lows down here with these relative equal highs to come up. And this is where they're going to be distributing all of their buy orders here, and they're going to be selling short because we have a daily bias to the downside. We expect prices to come lower. So we know they're selling above previous highs. So the way that I do this now is, first of all, when looking at this from a strat perspective, you have your very, very beautiful broad information back here. So nice, beautiful broad information, right? We know we want to short up here anyways. So we're going to treat this as our deviation from the range, which big words, I know, but we have these highs. This is your deviation. This is where prices are overextended, overbought, etc., etc. We know to be shorting in here. So now we're on a 15-second time frame. You might be like, what the hell? What's a 15-second chart? Well, this is where all the magic happens. So what we want to look for is we want to get a shift in structure with the fair value gap. And you can see we had shift in structure, no fair value gap. So that's not a valid shift in structure. Now, we had relative equal highs form here. Goes higher, breaks down, doesn't shift structure. Now we get, boom, displacement below this low. This is our shift in structure, market structure shift. And all it means is, very simply, we know the market trades something like this, where we make higher highs right here, and then we get some type of imbalance, then price shoots higher. It's the exact same thing. Now, understanding this, we have a fair value gap here. We don't expect this high to get taken out. And now we look for, where is our short entry going to be? When trading this way, I look to trade order blocks, and that's just my preference. When trading fair value gaps, what I look for specifically is liquidity sitting above a fair value gap to try and take it long or take it short. And reason being is just because when you have that liquidity sweep into the fair value gap, normally it just works better. So that's what I normally look for. But again, this video is not going to be an all-encompassing thing of exactly how I trade, because I'm still trying to figure that out myself, just to set some perfect rules for me, right? Everyone's trying to do that. But I focus on the order blocks. So we have this nice big green candle, then boom, big sell, broke structure, fair value gap. We know this is institutional price action, right? So seeing this, you could be shorting this fair value gap, risking all the way up to here. But what did we just talk about risk reward? That's risking 7.25 points, which can work, and you'll see that it can work. But I want to focus on the order block up here. And instead of ICT's idea of, I want to put my stop above this high, I am putting my stop above the order block. Just at the top of the order block. The reason being is, if this is institutionally sponsored and there's orders sitting in here waiting to get filled, why is it going to run through every single order all the way to the top, clear all the orders up here, and then reach for this liquidity if price is going lower? It's not going to. So this is going to be the setup for the trade. I'm looking to risk this 2.75 points, and your first target is going to be the lows down here. And reason being is because we had exactly what we drew out a second ago. So we had prices going higher. We had a shift in structure right here. This is also like a Quasimodo pattern, or whatever you'd like to call it. Move higher into some type of imbalance, fair value gap, and then we're looking for it to break lower. This is your first target. And understanding this pattern, how it continues, once we make this break lower, we know that we are moving stops to break even instantly. And since we're on a 15-second chart, that happens very quickly, right? So now we can go into the price action here, and you'll see this. We make relative equal lows down here. This gives me even more confidence. It's a double bottom, right, for retail traders, but relative equal lows, we know that's liquidity. Then we had all these relative equal highs on a smaller time frame. We're running that liquidity into the order block. Gives me very, very high confidence that this trade's going to work, right? So now, what's our position sizing? So if we're risking 2.75 points, Each point's $50. That's 137.5. So 137.5, we know to divide our risk on the account by that amount. We can take 7 contracts short. So we're shorting 7 contracts here. And I believe I can put this in. So 7 contracts here. $100,000 account. Simple. Now we let the price kind of do its thing. And you can see we broke that low. What did we just talk about? Stops to break even. And obviously I can't make it break even on this indicator thing, but our stops go to break even instantly. Now, where am I targeting? So if we knew that there was accumulation down here to run the highs back here, stop people out, and then accumulate shorts for the downside bias on the daily, then we know that we're likely running these lows. So instead of ICT's idea of you take the range from here to here and we should be getting out under the 0.5 level, we're expecting this range to broaden to the downside. So I'm not aiming for this internal range liquidity. I'm aiming for external range. And that is because if we go to that 12-hour, once we take the low of that previous 12-hour, our magnitude and our target is going to be to take the low of this 12-hour all the way down to 4182.5. So now if we go back to the 15-second chart, stops go to break even right there, risking nothing. And you have 7 contracts of ES short. And our first target, I want to get to the bottom of this range. That is 30.75. Maybe could be a little different. Let me go like this. Yep, so 31 points. That's my first target. So if we let this play out, boom, 31 points. That's the first target. So if I have 7 contracts and just very roughly, I don't have very set rules on how I take my partials, but very roughly what we can do is we can go onto the 12-hour. We can say, okay, this was our first target on this trade. This is our second target. And then we're looking for daily magnitude. So we have 3 targets, 7 contracts. We'll take off 2 contracts per target and then 3 contracts at the very bottom. Works out very simply, right? So now if we go back to the 15-second, we're taking off 2 contracts right here. So 31 points times 2 times 50. This trade is break-even stops. You're plus $3,100. Pretty solid, right? And let me make a note of that over here. Can I pin this? I guess not. Okay, I'll leave it on this screen. All right, so $3,100 locked in, break-even stops, no risk on the trade. That's a really good payday. Anyone would be very, very, very happy about that, right? But we're expecting prices to go even lower, and we have all those contracts short from up here. So what you can do, and if you want to, you can move your stops and be like, okay, well, if we come back up to this part of the range back here, then I'll stop out. So it's like you can lock in another 10 points. And if you have, what, 765, you have 5 contracts left times 50. You could be locking in saying, okay, well, guaranteed $2,500 on the rest of the contracts, plus that $3,100. That's a $5,600 trade right here. Simple. Or you can leave those break-even stops on and you can let the trade kind of do its thing, right? And this is kind of what I preach, even when talking about trading stocks, which again, I do not use ICT stuff on stocks very often, if at all. And I trade stocks very, very differently. So I would not apply this to stocks. You can if it works for you, good for you. But I personally just don't. But that is your first partial right there. Get that back on. So guaranteed $3,100. And if we go and look at the 15-minute, you can see that took 30 minutes. So you're up $3,000 in 30 minutes. We go to a 12-hour, which it's not going to let me show the developing 12-hour candle, sadly. But that is just triggering that 12-hour to the downside right under this level here. So our next target is to come all the way down to here. So if we go back to like a 1 minute, now our next target is going to be to come and take out 4182.5, which is simple ICT liquidity stuff. So same exact thing as strat with our targets. We're looking to take out those previous pivots. Now, if we let this kind of play through, now that target has been met. So we can, let me extend this out. Now, if we look at our risk reward here, after we break even to our stop, we'll just move the stop up to, it was 2.75. Your risk reward's 1 to 29, just about. Pretty nice. And this is our second target on the trade. So now we're taking 2 more contracts off at 78.25. That's banking another 7.8 thousand, so 7,825. Now the whole trade is up just about $11,000, and you still have 3 contracts short, and those contracts are up about $13,000 right now. Now, if we go to like a 15-minute, this is where intraday trading comes in. So if you are trading intraday, and let's say you just missed this trade, this is where Strat and ICT really help each other. So after taking that low, Strat, we do expect pullbacks after that low. Do we know how high they are going to go, though? No, we do not. So this is where ICT comes in to help. We have a fair value gap on the 15-minute sitting right here. So understanding that, we expect prices to retrace and come back into here. So if we go into an hourly chart, and I fast forward here, oops, actually, we'll go on to a 30-minute. I believe that's where it was. So 30-minute, also a fair value gap sitting here. This is where you get a 30-minute triangle day out, right? So instead of expecting this 30-minute TTO to triangle day out and then just bring us all the way back to the downside, we expect it to reach into this gap. So we know the corrective activity isn't over yet, right? Now, the next one comes in, reaches into that fair value gap, retests these lows, which it is your breaker block if you know ICT, but fair value gap makes it really simple. Runs those highs back here. We had a false flag or the creation of a Judas swing right under where we expect prices to turn. And this isn't, I'm not going to go into the really low time frames, but really simply, here's your strat reversal, breaking the previous candle's low, and here's your stop loss. If you wanted to take the intraday trade, that's risking 3.5 points, not too bad, and your first target's down here because of the phenomenon that we know about in price, where prices go lower, go break higher, go lower, break this low, imbalance, go lower, takes out liquidity, right? So same exact thing here where it reaches higher, imbalance, looking to come and take out that low. And you can see, boom, there's your first target. And now you're in the exact same trade that we're in from the highs, right? And now, once it hits that first target, where are you going to next partial at? That daily magnitude, all the way down at 4129.5. So that's a 132 point move, just about. And that's 1 to 48 risk to reward. This is where risk to reward is just, it's beautiful. It makes things so much nicer. And you can see, let's say you added back to that position, you added another couple contracts, which I'm not going to do the math on like profit and whatever, but let's say you added back, short position right here, stop right at that 3.5. You had that first one, that's a 1 to 6. And then next target all the way down to here. Oh, actually this, yeah, there we go. Next target all the way down to here. That's, you just added another 1 to 20. And when people say 1 to 20, 1 to 30, blah, 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 that's 30 times your risk. So if you're risking 1% of your account, then you're adding 30% to your account. Very simply. So that's how crazy this stuff can get. Just like options, right? So now we can let price play out. There it is. So that target's been met, and you can see you're risking 3.5 points, pretty much nothing, right? And once this target's been met now too, now we have 1 to 48. That's 133.25 points, and we have 3 contracts left because we had first partial at the lows down here of 2 contracts, second partial here, 2 contracts, third partial here. If we had 7 contracts to start, we have 3 left. So 3 times 50 times 133.25. That is we'll just say $20,000 on the last 3 contracts. So the total profit on this trade comes out to just about $31,000, just about. And that's one trade on a $100,000 account, $31,000, 30% on your account. Let's say we added in this. Let's say you added back 2 contracts here, risking that 3.5. You added back another 3.5 times 50, and you added 2 contracts. So you added a $350 risk to your trade, and you just profited. Let's just say you took, let's just say you let the contracts run all the way down to here for simplicity's sake. 71.5 times 50 times 2. Add another $7,000, 37% on your account. Doesn't matter what the size of your account is. In this example, that'd be another $7,000, or I believe I did the math there. So this is how I try and do my trading. Obviously, I don't get this perfect trading every single day, but when it lines up, and it only has to line up every once in a while. Look at that. We had a 1 to 50. That means you can be wrong 49 times, hit one trade, and you make money. So you can literally be the worst trader ever and have a 10% hit rate on like your good trades, and it can still work beautifully, right? So hopefully this kind of explained and brought you into my process when it comes to strat and ICT, and hopefully gave you some ideas when it comes to risk reward and taking positions and understanding where to take them, how to take them, etc., and how I use those really low time frames that everyone calls me a crackhead for using. But again, hope this video helped. If it did, please leave a like, subscribe if you're new and you're doing ICT stuff. I'll hopefully be posting some more things as I get this new funded account going on. I'm going to see how much money I can make from this funded account. I spent, I can't really bring it up, but it was a $50,000 account at Apex. I believe it costed like $100 or $80 or something. So we're going to see how much money I can make from that and flip into more accounts this year. And hopefully I can update you guys as we do that if I'm successful. And again, thank you for watching. Hopefully this helped. I will see you guys in the next video and hopefully on Twitter.